Kraft stock fits into that unique category of high yield dividend, right? 3 to 4% dividend yield is pretty good. However, Kraft Heinz is sitting at 5%. That is, in my opinion, high yield. Some would say, oh, it's actually 6 or 7. For a stock that's in this specific category, right? It's not like a REIT or something. REITs, it's a lot easier to get dividends much higher just because of the business they're in, right? This is a retail product, Kraft. I'm assuming all of you know what Kraft Heinz. In case you don't, Kraft mac and cheese, Heinz ketchup, all that sort of stuff. They have plenty of brands, and if you're interested, I would encourage you to look that up before buying this company so you actually know. But we're not going to dive all into that today. This stock provides a really good dividend, 5%. That is high. That is, in my opinion, that would fit decent in that high dividend yield portfolio that's aiming for 5, 6, 7% yield, but also, not necessarily matching inflation or exceeding inflation. You would hope you would in that portfolio, but not necessarily expected, right? You can see it has not outperformed inflation over the last 5 years. It's only up 5%. Inflation's up about 20% since 2020, right? Late 2019. So this is a stock that hasn't done that. And if we zoom out, it's going to look a little bit uglier, right? So this stock has had some issues with like competition from, like great value brand stuff, because they are cheaper, right? I don't know about you, but sometimes, the $2 Kraft macaroni just isn't cheap enough. I got to buy the 50-cent box from Great Value. I'm kind of just kidding a little bit, but seriously, I will do that sometimes, But so they do have competition with, retail stores being able to put products that are basically the same right next to them. So that is some headwinds they've had. Also the merger because Kraft and Heinz were two separate companies. The merger hasn't always gone as smoothly as was expected. We can actually see from the dividend, if we go here and look at the historical dividend, actually this is the wrong one. This is earnings. Oopsies. Bear with me, people. The dividend actually has fallen since 2015, 2016, 2017, right? So it was about the same rate. It's actually growing, and then it fell dramatically, and it's been flat, and actually it's probably going to be the exact same this year. We've only got 120. I would assume, I don't know for certain, we don't have the third. So it'll be flat since 2019, same rate. It's not lower. We just haven't received the third payout or the fourth payout this year. So you're probably going to always expect, as long as this company is doing fine, to get around that 5% yield, right? And this PE also, I didn't mention at the beginning, I usually do, right? 29% PE. The forward PE is probably a little bit closer to the accurate amount. You can see that forward PE bounces between 10 to 12. That normal PE is 28. I don't really think that's going to be indicative of the PE long term. I would assume I don't know exactly what's causing that, but we can see the earnings are roughly the same. There's probably some thing that happened that's just a fluke that caused it. Maybe they're paying off debt or this or that, whatever. There's so many things it could be, and I don't know the exact reason in this case scenario. If we're looking at what analysts have to say, right, 8% are saying buy or strong buy. The rest are saying hold. Analysts really aren't going to say anything crazy when it comes to Kraft Heinz. Primarily what I like it, like I said, I like it in two ways. I like it in a portfolio that's high yield dividend, right? I don't necessarily like this as a stand-in alone, like large percent of your normal portfolio, because I think it's too risky. When you have a stock that's fallen 54%, I expect it to probably flatline around this for a while, but it could keep going down, and it has a history of going down. So if you had like 5, 6, 7, 8% of your standard wealth into this, that would be rather extreme in my opinion. I don't hate the stock. I like it for its purpose, right? Which is mainly for the high yield dividend. Also a little bit of a recession hedge, right? The underlying products will do well during a recession, ideally. So it should do decent during that, but I wouldn't want a huge if you have a portfolio with 10, 20, 30, 40, 50 plus stocks, and this is one of them, it'll ideally, if you get enough of them, this one may underperform, two may overperform, whatever it may be, and they'll balance each other out. So you can mitigate risk that way with just having diversification to many other industries, and I would recommend that. Like I said, I think this company is fine, but other than as a recession risk that you're just holding on to, recession hedge, that you're just holding on to, or in a portfolio, I probably wouldn't recommend holding a large portion of your portfolio in this stock. I think it's too risky and there's not enough upside. I think you can get better risk for reward ratio. I would literally just pick a decent growing tech stock that doesn't have insane PE and just buy that if you just want performance. But like I said, if you want that income from it, the high yield, this is a decent one for that, right? It really is. Analysts think it's fine. We can look a little bit at what Schwab analysts have to say, right? Narrow moat, I don't really get that. It's probably closer to like in between here, right? It's like a 0 through 10 rating. I hate that, but that's just how it is right here. So this was reiterated yesterday. They think it's going to be in the top 41% of stocks performing over the next year. That is a good rating, certainly for a stock like this, which does not have a great track record of outperforming. So Schwab thinks it's going to do well, at least in the short term. I believe it's a 1-year outlook. So that's not a bad thing as well. There's some other weighted scores. It's kind of mixed, 4-star hold, avoid, buy. And then there's weighted issues scores. I'm not super knowledgeable on that, so I usually don't touch on that. Usually I go to analysts now. I did it earlier, but it's a mix. I think it was 8 analysts were saying buy, 13 were saying hold, 1 was saying sell. There's always going to be 1 or 2 of those. So there's nothing super crazy if you're curious about the stock that's like sticking out, like, oh, this looks terrible or this is scary. Other than this is the scariest part. Down 54%. I would not have a large portion of my wealth in this company, but I don't think it's necessarily a terrible company either. That's just my personal opinion, and I think I've said all I wanted to in this video. So if you enjoyed, I appreciate if you left a like, right, or subscribe. If you enjoy my content, I do daily stock content on this channel, everything from high yield dividends to Mag 7s to tech to all that sort of stuff. And whenever someone subscribes, it really does help. It helps YouTube. It helps me to have YouTube recommend my content. YouTube likes it when people subscribe and they give more views out. So it helps the channel a lot when you do hit subscribe. But anyways, I appreciate all of you for watching. I'll catch you next time.